How are you, Professor?
How are you?
Yeah, Professor, can I ask you a question about the book report?
Hmm.
All right, so I'm reading this book.
Yeah.
I don't know if you could see it. It was on the list. Super interesting. Uh,
Yeah.
have you read it?
Yeah.
Okay, so my question is, it's broken down by lectures.
Hmm.
So when I'm going through, would you rather me do it like speak about the first lecture, then thoughts, anything applicable to class, whatever, and then do it by lecture, or kind of just do the whole thing and sprinkle in thoughts in between?
I mean, it's up to you if whichever organization method works better to think through the. So the book is basic. So Bernanke gave a series of lectures at Georgetown, and then
Yeah.
so the lectures are online as well. Actually, if you want to watch them, they're
Oh,
fascinating.
cool.
Yeah. So then they turned it into a book. So he gave a series of 4 lectures, one on each aspect of the financial crisis. So that's how we broke it down. So, I mean, if it helps for you to just go lecture by lecture, just to collect your thoughts on each of those issues, that's fine. If you want to just read through and then do a comprehensive, because he connects all the pieces, there are 4 pieces.
Yeah, I'm basically done with it. I
Yeah.
have 2 pages.
So, I mean, it's up to you. I don't have preference on.
And then just one more question. On the book report also you write that if anything's like applicable to class. So there's obviously a bunch of things like when it talks about inflation and interest, like those are all things we dealt with, but it's not necessarily like specific to this class. It's kind of just economics in general.
Yeah. I
Uh,
mean, yeah. So he does talk about leverage. We touched on that quite a bit.
right.
Excessive leverage in the financial system and what kind of systemic risk that poses. So things like that. So if it's like a big topic that we discussed in class, that's the reason, right? The point is to just encourage you to read widely outside of the class itself. So that's why the list is like different people are interested in different things. Not everyone is interested in doing financial economics, but it's
Right.
just to give you an impetus to read a little bit more widely out of it. So if it fits within the class discussion, bring it in. That's great. If it doesn't, then don't try to shoehorn something that doesn't fit. So it's fine.
Okay.
Yeah.
Great. Thank you so much.
Yeah. What things otherwise?
It's good.
Yeah. Okay.
We're almost there.
Are you graduating this year or next year?
I'm graduating next January, hopefully.
Okay, so you have some time.
Almost there, yeah.
Yeah.
How are things by you?
Yeah, going on. It's a lovely day today. So I went
Yeah,
out
I
for
got
a
out.
run in the morning. Yeah, so it's good. Yeah. It's kind of hard to stay in when the weather starts to get good.
Yeah, that's why everyone on the news keeps hoping for bad weather, so people stay inside.
Yeah. No, I mean, I've walked out today and there's like, I've never seen these many people in the last few weeks. So
Yeah.
Right. Everyone's just, they can't stay in when the weather's this good. But yeah.
Yeah.
Yeah, no, it's almost done though. All my summer classes are online, so I'm working from home for the foreseeable future. So.
Oh, wait, has anyone said anything about fall yet?
No, hopefully we'll be back in person by the fall. I don't know what they're going to do. I mean, this works well for me because it saves a lot of time on commuting. There's
Yeah.
that. But I also miss
living
like just being in the classroom and interacting with students.
Yeah.
Yeah. Hello, Jacob. How are you?
Good, how are you?
Yeah, going on. 4:30. Okay, more people coming in. Let's see. So wait, we have May 7th is the last class, is it? Does anyone know? That was my understanding.
I don't think we have class next Thursday, at least not on the schedule.
Yeah. It's going to be tough to get through. All right, yeah, let's see what happens. So yeah, I was hoping that we had class on May 7th. I know it's part of the official reading period, but the exams are not for run the week after that. So, let's see what we can do. All right. Hey.
Maybe you're late.
You're muted. Sorry, Abram.
Got it.
Yeah.
Quick question.
Mm-hmm.
Homework.
Yeah.
Okay, I only with that number 6.
Oh yeah, I never got the...
Sorry, man. I just want to make sure I'm doing it right because I keep messing it up, I think.
I just completely slipped my mind. Was what chapter 6, question 6 was?
No, chapter 9, question 6.
Chapter 9, questions.
Did you ask about the lottery question?
Which one? Is that which one? The one that I'm talking? Is that?
It's the heads and tails one, right?
Oh yeah. That one was crazy.
Yeah. I'm just I'm trying to figure out a little bit.
Yeah.
I don't know
Question
what
six,
you mean
yeah.
by a diagram.
Also,
Sorry?
okay, so maybe I'll try and like word it a little bit better. When it comes to question 6, what we're trying to do
Mhm.
is we're setting up that inequality, right? Where the utility of the expected value of lottery for sure is greater than the expected utility of the lottery, right? That's kind of the gist of the question.
Mhm.
So in terms of what you're plugging into W, what
So
you're
the first part of the question is the difference between the expected value of the lottery and the expected utility that Charlie Brown gets from participating in the lottery. Okay.
okay.
So when the question goes, should Charlie Brown actually take the bet? The point is that, okay, based on expected value, maybe it's worthwhile to take the bet. Depends. You do the expected value calculation.
Right.
Then you see the expected utility that Charlie Brown gets under these situations because the utility is given, the utility function is given.
Right. So when you do the expected value,
Mm-hmm.
would you then plug in that to W?
Not yet, right? So if the criteria is that if it's expected value and you take any bets which are positive expected value, then based on that criteria, maybe he should take the bet. But then once you look at the expected utility from participating in the lottery, right?
Right.
So once he looks at the expected utility from participating in the lottery, maybe it doesn't make sense for him to take the bet if the expected utility is less than 0. Because if he doesn't participate in the lottery, his baseline utility is 0. Right? Because he has 0 cents, right? Where his current wealth W is 0. So his current baseline utility is also 0 if you plug it into his utility function. So when exposed to risk, if his expected utility is lower than what his current situation is, maybe he shouldn't take the bet.
Okay. Yeah.
Yeah.
Yeah. So that makes sense.
Mm-hmm.
And then, okay. I think that, and D, when it says compute the variances of the old and the new bets,
Mm-hmm.
what does that mean?
So we're just trying to find the variance, right? So we'll get into the variance stuff today for a second, but in general, you're trying to find the expected value. Let me just use a different one. Sorry. So in general, you're trying to find the expected value, right? So this is your average, the mean. And then in each of these states of the world, you're trying to find the deviation from the average. And then you're trying to find the square deviation and then find the variance using that formula. That makes sense?
Maybe.
So in each situation, this is the expected value of the bet, right? You can find the average that you would earn in each of these states of the world. So given in one state of the world, the payoff is something, in the second state of the world, it's something else. And the third state of the world is something else that gives you deviations from the average. So then you can square those deviations. And then use the sum of squares, right? So this is to find the variance.
Okay.
Okay, so that's what question D comes down to.
Yeah,
Question C just alters the game and sees if raising the stakes alters behavior in one sense.
So we're not really using the expected value, the utility of the expected value of the lottery.
Not like the, so the only reason when we use this utility of the expected value of the lottery
Yeah.
versus the expected utility of the lottery, right? So if this is the expected value of the lottery X and this is the expected utility of lottery X, you only use it to check for risk aversion,
Ah.
right?
Are we just assuming, we're assuming that Charlie Brown is risk averse?
So you can determine that by looking at his utility when he receives the expected value of the wager for sure relative to the expected utility of the same wager. So you can, using that calculation, you can conclude whether Charlie Brown is risk averse in one bet. So it might change depending on the bet. Charlie Brown might change whether he's risk averse or not.
What does it mean by part B? Do figure it out with the diagram. I don't know what diagram it meant.
So the diagram is basically trying to ask you with wealth, all right, how is this utility evolving? At different levels of W, how is its utility evolving? Is it like this? Is it like this? Is it a linear function? What is it? It's not going to be linear because the utility is a second order, it's a polynomial. So you're going to get a curve.
Oh, so since he's risk averse, it would be concave, and we would show it like that.
Yeah.
Okay.
Okay. Make sense?
I think so.
I mean, I'm only grading for effort. So
Yeah.
obviously just, I mean, it's an interesting question. The wager keeps changing and the behavior kind of slightly alters. So it's, you know, it's there to just give you a workout on how to think about these issues.
And it's due by next class.
Yeah, I mean, I won't send out one more assignment before we are done. I am told that maybe Tuesday is the last class. I was hoping that Thursday was the last session. Worst case, I mean, I'll try to record the session for Thursday, one more session, and just send it out as a video lecture, I guess. Because I don't think we'll have enough time to finish up with all of CAPM, and I don't want to like not finish CAPM because that's kind of an important part of this class. You need to see the derivations for CAPM. So let's see what happens by Tuesday, and then I'll send out the assignment. I'll post the next assignment right away today at the end of the class, so you can start looking through it. Chapter 13 and 14 is what the assignments are. So we'll see.
And when would that one be due?
Sometime during reading week, I think the following week. So, you know.
The following Tuesday?
Yeah, following Tuesday or the following Thursday. That's good. All right.
Are you going to do this portfolio chapter is which chapter?
13 and 14. Right now we are on 13. We'll finish up with 13 by Thursday. 14 is going to take, I mean, it'll take 2 sessions for sure. I know for a fact that we can't finish it in 1 session. So we'll see what we can do about that.
Are you going to do a review session?
Unless you guys are okay with showing up on Thursday so we can finish up the CAPM stuff. We can have a review session during the reading period, of course.
Yeah, can we set that up?
Yeah, I can set it up. Like, I'll keep it around the same time on a Tuesday or a Thursday, so it doesn't conflict with anything else you have going on that week.
Awesome, thank you.
Yeah. All right. Anything else before we get started?
Yeah, Professor, the final is going to be the same idea, like 5 questions on camera and hour and 15 minutes, or it's longer? What's the story?
It's supposed to be longer. It's supposed to be a 2-hour, 15-minute exam. So the final is always longer, but I'm going to try to keep the length of the exam to about the same as the midterm, maybe slightly longer, because some of the questions are a bit more involved. So you'll have the entire exam period, the 2-hour, 15 minutes that's assigned to the exam, but it should be about the same length as the midterm, maybe longer by maybe 10, 15 minutes, not more than that. Okay. All right. Anything else All right. Then we can get into the material for today. So, okay. So last class, we started talking about, when we talked about mean variance portfolio analysis, the first thing was to consider the expected return on the portfolio, right? So we are talking about the two risky assets case, where there's only two risky assets to choose from. Then the expected return on the portfolio was W1 expected return on the first asset plus 1 minus W1 the expected return on the second asset. And the portfolio selection problem was basically to choose W1, right? Choose W1 such that it maximizes the expected return on the portfolio. The second part of that entire analysis is to talk about portfolio risk in general. Okay. So with portfolio risk, we started talking about it last class. We were going to use variance or standard deviation as the mathematical representation of risk. Right? This is how we are going to try to capture risk in general. So we said risk is any deviation from expectation. So variance and standard deviation are both measures of deviations from expectations. So that's the relevant thing that we use. Okay. So when we have two assets like this, right? So, okay. So there's a bit of statistics here. So I'll just use this as an aside. So there's a couple of things. The variance of xy, where x is a random variable and y is a random variable, is given as the variance of x plus the variance of y plus 2 times the covariance between x and y. Okay, so when we want to find the variance between x and y, it's given as the variance of x plus the variance of y plus 2 times the covariance of x and y. So there's three things to really take into account. So the variance of ax, if I multiply this random variable by a constant, where a is a constant, then this is a square times the variance of x. Okay. And the third thing is that covariance of ax is just a times the covariance. All right. Now, it's beyond, given the time we have to show you where the proofs come from is beyond the scope of what we can do. But I just want to quickly talk about what this covariance term actually is doing here, right? What this covariance actually means in general. So covariance, so there's two variables, x and y, right? X has its own mean, y has its own mean. Right, so the average, both of them are random variables. So both of these are random variables. So there's an expectation on x and an expectation on y. Right? What covariance tries to do is to say, suppose x deviates from the mean by this much. If this is the deviation of x from the mean, what is the corresponding deviation in y from the mean? Right? So this is trying to establish how these two variables move with each other. In a certain sense, that's what we're trying to do. We're trying to establish some kind of relationship in movement between x and y. If x moves by this much away from its mean, what is the corresponding move in y away from its mean? Right? So that's what covariance in general. So you would sum this, obviously, and then divide by n or n minus 1 based on the population. But the crucial thing is to recognize is that the logic of a covariance is to say, if x deviates from its mean, y, which is a variable which might be related to x, would also deviate from the mean. And this is the magnitude of y's deviation from the mean for a given deviation of x from its mean. So that's what covariance is trying to capture. Okay. Right. Again, if you've not taken a statistics course in college, I highly recommend that you do. It's very useful to understand all of these cleanly in general, because we use it a lot in economics and finance in general, these ideas. But in a nutshell, that's basically the entire thing around covariance as to why we use covariance. Right? So the 2 comes from the fact that there is the covariance between x and y, and then there's the covariance between y and x. It's symmetric. So that's why we get 2 times the covariance of xy, because covariance of xy is the same as covariance yx. So we get 2 times the covariance of xy. So the formal proof is, I mean, we don't really need it, but these are the 3 results that we actually want to use. Okay. All right. All right. Any questions on this stuff so far? Okay. All right. Then, if you think about what the portfolio consists of, right? If you think about what a portfolio consists of, portfolio consists of a weighted average of the first asset and the weighted average of the second random variable, right? W2 or what, where W2 is just 1 minus W1. Okay. So just the weighted average of 2 random variables is what the portfolio consists of. Right? So the variance on the return on the portfolio is the variance between these 2 random variables, W1R1 and W2R2. Okay. So we just use this result where the variance of x and y is given as the variance of x plus the variance of y plus 2 times the covariance of xy. So we can write this as the variance of W1R1 plus the variance of W2R2 plus 2 times the covariance between W1R1 and W2R2. Okay. All right. So one thing we recognize here is this W1 and W2 are constant. So we are using this result that the variance of a times x is a squared times the variance of x. So this is basically, you can write this as W1 square times the variance of R1 plus W2 square times the variance of R2 plus 2 times, if you look at the covariance formula, it doesn't get squared when it comes out of the brackets when it's a constant. So you get 2 times W1, W2 covariance between asset 1 and asset 2. So we can write this compactly as the variance of the portfolio is W1 sigma 1 square, where sigma 1 square represents the variance of the first asset, plus W1 square, sigma 1 square, so W2 square, sigma 2 square, which is the variance of the second asset, plus 2 times W1, W2, sigma 1, 2. Sigma 1, 2 represents the covariance between asset 1 and asset 2. All right, so far so good. Any questions on this? Okay. So that's one thing to take into account. The second thing that we want to highlight here is this notion of a correlation coefficient. So the correlation coefficient, this is the letter rho. The correlation between asset 1 and asset 2 is given as the covariance between asset 1 and asset 2, covariance between the returns of asset 1 and asset 2, over the standard deviation of the first asset times the standard deviation of the second asset. Okay. So in a certain sense, what covariance is, what the correlation coefficient allows us to do is to compare between different kinds of assets, because if everything is scaled by their own standard deviations, we can compare across different relationships between different assets, right? Because if sigma 1 and sigma 2 are different, so here's the story. So suppose I have 3 assets, 1, 2, and 3. So I can find the covariance between asset 1 and asset 2. And I can find the covariance between asset 2 and asset 3. but I can't compare these two quantities directly because the standard deviation of asset 1, the standard deviation of asset 2, and the standard deviation of asset 3 are not alike. So to make sure that we can scale for those differences, we divide this by sigma 1 times sigma 2, and here we divide by sigma 2 times sigma 3. So here I get the correlation between asset 1 and asset 2. Here I get the correlation between asset 2 and asset 3, and I can compare between these numbers. Because this correlation coefficient is always going to be a number. This correlation coefficient between any two assets I and j is always going to be a number between -1 and 1. Okay. It's always going to be a fraction. It's the covariation, and the covariance is a fraction of the underlying standard deviations. So that allows us to, because it's always a fraction between -1 and 1, we can order them. We can actually compare between those. So a lot of this, if you have some statistics before, should be familiar territory. If you're completely stone cold, no statistics before, this is kind of a place where I'm guessing you're scratching your head a little bit, because it's a lot to just throw in ideas around covariance and correlation all in one go. But the crucial thing to recognize is that the variance formula for the portfolio, right? So we are just, the portfolio is constructed using weighted averages of two different random variables. So the variance of that portfolio is the variance of those two weighted random variables. So we use the variance formula to derive a formulation for the variance of the portfolio, right? So the crucial thing here is that with the correlation coefficient, sigma 1, 2 is given as the covariance between asset 1 and asset 2 over the standard deviation of the first asset and this times the standard deviation of the second asset, which means that we can write the covariance between asset 1 and asset 2 as the correlation coefficient times the standard deviation of the first asset times the standard deviation of the second asset. I'm just multiplying these things out to the other. So, which means that sometimes you will find the formulation for the variance on the portfolio, which is also written as sigma square p, the variance on the portfolio, is W1 square sigma 1 square plus W2 square sigma 2 square plus 2 times W1 W2, the correlation coefficient, times sigma 1 times sigma 2. I'm just substituting for the covariance as a function of the correlation coefficient, right? So sometimes you see the formulation of the variance written this way, where everything is written as in terms of the standard deviations of each of these two assets. All right. Any questions on this stuff before I get any further beyond this? Okay. Sometimes instead of using the variance, we might want to use the standard deviation of the portfolio return. The standard deviation of the portfolio return is written as sigma p, which is just the square root of this entire thing. Okay, so this will be the square root of W1 sigma square plus W2 sigma 2 square plus 2 times W1 W2 sigma 1 2 rho 1 2 times sigma 1 times sigma 2. So sometimes we use this measure, sometimes we use this measure. It depends on the model we are constructing, which is the better measure, but both are measures of variation, both are measures of risk. One is where you're normalizing the units by taking the square root. One is just in squared unit terms. The variance is in different units. Always remember that that's the problem with the variance, is that the units on this, because it's a squared measure, is always going to be, if it's measured in dollars, it's going to be dollar square. So sometimes we just want to use the right units there, so we can make comparisons across different categories. So then we can use the standard deviation to normalize the units. All right, So before I go anywhere further, I just want to see if there's any questions on any of this.
What are we trying to do right now with all these formulas?
So when it comes down to portfolio selection, if this is the way to think through it, we are trying to consider the expected return and the level of risk that you need to take to get to that expected return, right? The trade-off in portfolio selection is not about just maximizing expected returns. It's maximizing expected returns subject to taking a particular level of risk. So with the expected return on the portfolio, we have a formulation already. The expected return on the portfolio is W1, the expected return on the first asset, plus W2 times the expected return on the second asset, where W2 is just 1 minus W. So we know this. So here what we are trying to find is to find a measure for portfolio risk. So we are looking at the portfolio risk as a function of the weights. So W1 square times sigma 1 square, W2 square times sigma 2 square, plus 2 times W1, W2, rho 1, 2 times sigma 1 times sigma 2. So this is just mathematical formulations of representing expected return on the portfolio and the level of risk inside that portfolio for this weighting scheme. Right? So that's the big picture as to why we are after this portfolio risk, is to establish the trade-off between the expected return and the level of risk you need to take in order to get that expected return. Does it make sense?
Yep.
As to why we are doing all of this. That's basically what we're trying to do.
I didn't fully understand the derivation of it, but I understand, now I understand what we're doing.
Yeah, so this is part of the class where I wish that, there's a strong prerequisite to come in with statistics, because to do this derivation properly, I just have to start from class 1 in statistics and build to lecture 14 in statistics to get that far. So in a certain sense, maybe, I hate jumping through hoops there a little bit, because I'm asking you to take it as an article of faith that this formula actually works. But as long as you are willing to go along with me to understand that the formula works, then the rest of it, I think, is straightforward, right? So if the variance between two random variables xy is given by this formula, then the two random variables in our portfolio are W1 R1 and W2 R2, where W1 is a constant and W2 is a constant. So we just using these three series of results from statistics to just derive this formulation out. Okay. All right. Any questions on any of this? Okay. So I mean, it's hard to talk about portfolio selection without having this framework, because this is the basic ideas here. Because at the end of the day, portfolio selection is a trade-off between mean and variance, risk and return. The mean is the expected return, which is the return, and variance is the risk. So in a certain sense, we have to talk about risk-return trade-offs inside the portfolio. All right. Any questions here? All right. Yeah. Was there a question? All right. One massive idea as to why you would even want to do any kind of portfolio selection comes through from this notion of diversification effects. Okay? The effects of diversification are massive, from putting together two different assets with random returns, and we can see this, right? So in a certain sense, what we're trying to do with diversification is that the level of portfolio risk can be driven down. The amount of risk inside the portfolio can be driven down by combining assets with some desirable properties. Right? It's not just any two assets that you can put together to drive this down, but in a certain sense, what we mean by diversification is that we can drive down the portfolio variance or the risk inside the portfolio without sacrificing, in a certain sense, expected return on the portfolio too much. In some limiting cases, we won't even have to give up any expected return, but still drive down the level of risk that we are taking to earn that expected return by just combining assets inside the portfolio, which have certain desirable qualities. Okay. All right, so that's basically what diversification in a nutshell is, right? It's the closest thing there is to what we call a free lunch inside a financial market. Right? You can drive down how much risk you're taking inside the portfolio drastically without losing expected return, because in a certain sense, the trade-off is between expected return and expected risk, right? You can have very high expected returns with very high levels of risk, have very low expected returns with very low levels of risk, but there is a way to drive down the risk without making the expected return dive along with it. And the only one way we can do that is through diversification, through expanding the pool of assets that we put together inside the portfolio so that we can drive down the level of risk we are taking without sacrificing expected return too much. Right? To actually see that this would work, we can take the simplest case here, where we have two assets, right? Where let's say the expected return on both the assets is the same. Right? Both assets have the same average return. Suppose the variances are also the same. The level of risk in each of these two assets is also the same. Okay? So the two assets are no different. They have the same expected return. They have the same level of risk, idiosyncratic risk. And suppose we consider an equal weighted portfolio. Okay. So equal weighted portfolio basically says W1 is 1/2 and W2 is 1/2. So you take your money and distribute it equally between the two assets. Okay. So let me call this mu actually. Okay. So suppose the expected return is mu on both of them. All right, so let's try and put together a portfolio like this. The portfolio consists of these two assets, which have the same expected return, the same variance, and we put them together in the same proportion. Half of it on the first asset, half of it on the second asset. So the only two things that we need to care about is, the first thing is the expected return on the portfolio, which is W1 times the expected return on the first asset plus W2 times the expected return on the second asset. So in this case, it'll be 1/2 times the expected return on the first asset, which is just mu, plus 1/2 times the expected return on the second asset, which is also mu. So the expected return on the portfolio is just mu. Right? We can earn on average from this portfolio with this kind of a weighting scheme, an average return of mu per year. Okay, that's the expected return side of it. The other consideration is that, okay, this is the average return that the portfolio will generate. What level of portfolio risk do I carry to generate this return? What is the level of the variance inside that portfolio? I know the variance is W1 square sigma 1 square plus W2 square sigma 2 square plus 2 times W1 W2 rho 1 2 times sigma 1 times sigma 2. All of the gains from diversification is going to come down on how these two assets are related, right? everything we have from gains to diversification comes down as to how these two assets move with each other, right? We're trying to put together a hedged portfolio, right? If the two assets move together in the same direction, it's not possible to really lower portfolio variance too much without sacrificing portfolio risk a lot, right? It's not possible to lower portfolio risk a lot without lowering portfolio return quite a bit as well, right? In a certain sense, the relationship between the two assets allows for us to get gains from diversification, right? Suppose in the simplest case, case one, right? Suppose there's no correlation between the two assets. This is what you're trying to do inside a hedge, right? If there's no correlation between the two assets, rho 1, 2 is 0. So if asset 1 moves by some amount from its mean, asset 2 doesn't react to it at all. So it's like picking one asset, a mining company in the US and a small pharmacy company in Papua New Guinea, right? If those are the two stocks that you want to put together in the portfolio, reasonably, there are ways through which you can argue that they still have some correlation. What happens to the mining company in the US might have some ripple effects through some different channels on the small pharmacy in Papua New Guinea. But for the most part, these two assets are independent, right? One is not going to influence the other. This is a case where the assets are independent. In a certain sense, if I'm being technical, they are statistically independent, which is to say the covariance between the two assets is 0. Okay. Suppose the two assets I choose are statistically independent, right? So these are the two assets I have. They have the same expected return, the same kind of risk, but they are not related to each other. They're not connected to each other in any way. If I put together this portfolio, then if I look at the variance on the portfolio here, W1 is 1/2. So 1/2 squared is 1/4 times sigma 1 square plus W2 is also 1/2. So 1/2 times sigma 2 square plus 2 times W1 sigma 1, 2 is 0. So this goes away. This entire term is 0. Okay. So that entire term goes to 0. Sigma 1 square and sigma 2 square are the same. So this is basically, okay. Oh boy. Sorry, just give me a second. There. So this is basically 1/4 sigma square plus 1/4 sigma square, which is sigma square over 2. Okay. So what do I have? The expected return on this portfolio is mu, which is the same as the expected return I would get from either choosing asset 1 or asset 2. But the variance on the return on this portfolio, but the variance on the return of this portfolio is sigma square over 2, which is half the variance of either asset 1 or asset 2. Asset 1 has a variance of sigma square, asset 2 has a variance of sigma square. So I'm getting the same return that I would have gotten had I invested in each of these assets, either of these assets at half the level of risk, right? So I've driven down risk by half without sacrificing any expected return, right? And this is a classic example where if I choose the right combination of assets, I can drive down the portfolio risk a tremendous amount without losing any expected return. This is a free lunch. I'm earning the same expected return in the portfolio as I would have with by choosing to invest in one of these two assets and being exposed to their risk, which is sigma square. Or I could put these two assets together in the same half on one and half on the other, get the same expected return inside the portfolio, but my risk level is now half of what it would have been had I chosen each of those individual assets to invest in, right? So this is a case where you have this entire move that you see here. This is all driven as gains from diversification. These are not two assets which behave differently. These are not two assets which have different expected returns. These are not two assets which have different risks to begin with. These are assets with the same characteristics, same expected return, same level of risk. We are weighting them half and half. It's not the gain is not coming from weighting them half and half either. It's purely driven by how the assets are related. If the two assets are not related to each other, we are able to lower the level of portfolio risk without sacrificing any return. This is a case where you have what we call a perfect hedge, right? So this is a perfectly hedged portfolio.
So this type of strategy would be used when you're trying to have an expected return, and not when you're necessarily trying to maximize a return, right?
In this case, the expected return and the maximized return is the same thing. I think the question, so in a certain sense, if I want to maximize my return, I have $100 in my pocket and you come up to me and give me these two assets and say, choose one. If I was only after the maximized expected return, I would choose, I'm indifferent. I could choose one or the other and I get the same maximized return, right? But I could maximize that return because when I put them together in my portfolio, I'm not losing anything in expected return terms. But at the same time, I'm able to drive down the level of risk I have to carry in order to get the same expected return. So in here, there is a sleight of hand. So expected returns are the same, but they might have very binary payoffs, right? So for instance, asset 1 and asset 2, right? So if one asset pays $100 half the time and pays $0 the other half of the time, the expected return on this asset is $50. Okay. Asset 2 might pay $25 half the time, $75 the other half of the time it might pay $75. The expected return on asset 2 is also right. So in this case, both assets have the same expected return. But depending on what state of the world I end up in, these two assets might be preferable on a different dimension, right? This is a kind of a lottery. Right? If I hit it big. If I lose big. It's kind of a binary asset in that sense.
Yeah, but meaning like in the asset 1, like your risk is clearly higher, but the reward is also higher. So your expected return might be the same as the second asset, but the maximum payoff is clearly greater. So meaning.
So in this sense, the sigma 1 square is not going to be equal to sigma 2 square. This is going to be clearly higher on this end. If I calculate the variance on asset 1, then it'll be clearly higher than this. So in a certain sense, if you're asking that question, that is a valid concern that two assets which have the same expected return, that's not enough information. You need to look at the kind of variance that you're carrying on each of those assets to take into account what is the risk adjusted return. Adjusted for this level of risk, what is the return I'm getting, right? So in this case, when we're talking about this perfectly hedged portfolio, there's no differentiation on the risk level either. It's the same level of risk for the same level of return. So we're not talking about assets which have like that kind of stark differences in payoff structure.
But outside this type of example, is there like a type of principle that like usually things that are correlated will have like better payoffs together? Like compared to ones that are like no relation at all?
So it depends, right? If two assets, we'll get into the other cases where there's positive correlation, negative correlation, and imperfect correlation. So depending on the correlation, you can generate different things. But if you're trying to minimize risk as much as possible, the one way you try to minimize risk as much as possible without sacrificing expected return at all is that if you're able to find two assets which are comparable on both the risk and return dimensions, but they're unrelated to each other. So instead of exposing myself just to the fortune, so it's as if I find two assets with the same profile. I have options. Either I put all of my money in the mining company, or I go and put all of my money in the pharmacy in Papua New Guinea. If either one of these two things goes bankrupt, then I go bankrupt with them. All my wealth is lost with them. So, but if the risk return trade-offs on both assets are the same and they're unrelated, I hedge my bet by distributing my money half on one asset, half on the other asset. So I lower the level of risk I take because I'm not exposed to the idiosyncratic risk of any one company. I'm just splitting my money. So half the time I reduce my risk on that dimension, but the expected return stays the same. That's kind of the genesis of a hedge fund. A hedge fund's entire strategy is to try to put together a portfolio which hedges the upside of one asset against the downside of a different asset, so that on net they're trying to minimize the portfolio variance as much as possible. They're trying to find classes of assets which are uncorrelated such that they can drop the portfolio variance as much as possible without sacrificing the expected return on the portfolio in too much. Unless you're able to find a perfect hedge, you will always lose some expected return when you do this kind of splitting. In general, you will lose some expected return, but if you are able to find two assets which are like this, then you can get away without sacrificing expected return while dropping risk. Yeah. All right.
Then by the same token, you need them both to do well instead of just one doing well. Meaning, let's say you were to put all your money into one of those two investments you were saying, you only need one of them to do well. Meaning, like, I kind of get what it's saying just intuitively. It's just a little bit hard to understand.
I mean, it's not about one of them doing well or not. It's like, imagine that I have $100 and I go all in on the company in the US, okay? Or I go all in on the company in Papua New Guinea. So if that company fails, my $100 is gone with it, right? So these are assets with the same kind of behavior. They will generate the same average return, the same level of risk. But if one company goes down, I go down with that ship. So if there's two assets which will generate the same kind of return for the same kind of risk, what the strategy is dictating is that I can get to the same expected return on average inside by combining these two assets while lowering my level of risk. Because I'm exposing myself to the same kind of return structure, but in an uncorrelated way, right? So it's like saying, take $50, put it on the company here, take $50, put it on the company there. When both of them are doing well and they generate the same expected return, I will make the same average return from both streams. But my level of risk exposure is halved because I've basically split my money between the two companies.
Meaning, if you put $50 in each one or $100 in one, you're as likely to double your money either way. You're just less likely to lose all your money.
Mm-hmm.
I was thinking of a scenario. Let's say someone offers you you can either flip a coin. If it lands on heads, one time you get 100, or you flip it twice, and if it lands on, and each time you get 50. Would that be the scenario, or that's different because the variance would be different in those cases?
The expected returns are also different, right?
Meaning, but you get to do the $50 coin flip twice, or you do the $100 coin flip once. I was thinking that.
Right. Yeah. Yeah, it's the same structure. You're getting into one thing which we skipped over, which usually is left over for a master's level course, which is known as an idea called stochastic dominance. So in a certain sense, we can try to generate these payoffs where, you can get to the same expected return with different kinds of payoff structures, right? Like in this particular case, it's like 100-0 versus 25-75. I can form different streams, but the risk is going to be higher, right? So you're saying, okay, so I can play this game once or play the other game twice. In the first case, my expected return will be 50 from playing the game once. In the other case, on each trial, my expected return is $25 on each trial, so I earn $50 in total, right? In expected return terms. So yeah, I mean, that would make sense, but you are like the return structure is the first trial needs to end based on what happens on the first trial, the second trial needs to go on. Right, so it's going to be 1/2 times 1/2. So a fourth of the time you end up in this state of the world, a fourth of the time. But the point is well taken, because if the two trials are what we call Bernoulli trials, where they're independent of each other, then it makes sense. So I much rather take the second one over the first one in that sense, because the variance on each of those trials is lower. Make sense? The average is 50, but it's 25-25. The average is 50 versus 100-0. The second one dominates the first one in a stochastic sense, in a risk sense. The variance is lower on the second scenario over the first one. All right. Okay. Any other questions from this? Right. So of course, this is a very stylized case. In general, things are much more complicated when the expected return on the first asset is not equal to the expected return on the second asset, and sigma 1 is not equal to sigma 2. If this is what we generally find in the world, that it's very hard to find a perfect hedge like this, right? So we want more realistic and consider cases where these two are not, the two assets are not comparable in terms of risks and return, right? So in general, the portfolio will consist of different kinds of assets with different expected returns and different levels of risk. All right, so to see this, so I mean, let's use an example, I guess. Suppose we have asset 1 and asset 2. Okay, so suppose the expected return on the first asset is 4%. The expected return on the second asset is 8%. The standard deviation on the first asset is 6%. The standard deviation on the second asset is 10%. This is a case where we have two assets which differ in both dimensions. The expected returns are not the same. The standard deviations are not the same. So we can consider different cases here. Suppose the relationship between the two assets is 1. If the correlation between the two assets is what we call perfect positive correlation. In a certain sense, what a perfect positive correlation is about finding two companies within the same sector, right? Like trying to invest in Coke and Pepsi. Let's say, for instance, you want to go out and buy a stock, they're in the same sector, they're very correlated in the sense that if the fortunes of Pepsi go up, fortunes of Coke might also go up with it. Like maybe not Pepsi and Coke because they're very too close, maybe Pepsi and I don't know, Sprite or something. In a certain sense, what happens if the industry leader moves up, the rest of the industry also gets pulled up along with it, right? There's sectoral correlation, and they're very highly correlated together in the sense that they move in the same direction. If Pepsi goes up, the rest of the soda industry goes up with it. If Pepsi comes down, the rest of the soda industry comes down with it. So in the sense that we are considering a case where if one stock moves by 10%, the other stock is also going to move by 10%.
Wait, so how do you balance them being in the same sector with them also being like substitutes for each other and them being like competitive?
I mean, in a certain sense, we are thinking of, if you want to visualize what's happening, it's like they're all getting traded as part of the same basket. Right, that's the thing. That's how correlation is measured. Like in the sense that because they form the same sub-segment or sector, they're all traded as part of the same basket in a certain sense. If it's like an ETF product where they're all trading as part of the same product, you're going to have like, if one asset goes up, the other asset also reacts in the same direction too. So to your question of what is the argument that when they're substitutes, that's why I backed away from my Coke and Pepsi argument. So Coke and Pepsi are perfect substitutes almost. So maybe Coke and soda water, any carbonated drink, some other fizzy drink that's on there. Coke goes up, there's an increased demand for soda type product in general. So the other stock also reacts positively to the increasing pressures in Coke prices, for instance. So it's like two firms which make basically almost the same product in the same country, in the same subsegment, something very close to that. All right, so what is the portfolio variance? If I put this two stocks together, it's W1 square sigma 1 square, W2 square sigma 2 square, plus 2 times W1 W2 sigma 1 2 times rho 1 2 times sigma 1 times sigma 2. So this is W1 square times sigma 1 square. Okay, let me just write it. Sorry. Sigma 1 square plus W2 square times sigma 2 square plus 2 times W1 W2 sigma 1 2, because rho is 1. Because the two assets are perfectly correlated, perfectly positively correlated, then I get this. Okay. So straight away the formulation is, this is W1 sigma 1 square, W2 sigma 2 whole square, plus 2 times W1 sigma 1 times W2 sigma 2. Okay. Takes the form of A square plus B square plus 2 times A, B. Okay. So this is the same as, so sigma square P is the same as W1 sigma 1 plus W2 sigma 2 squared. Right? Because A square plus B square plus 2AB is the same as A plus B whole square. Okay. All right. So the standard deviation on the portfolio would be the square root of that, which is W1 sigma 1 plus W2 sigma 2. Okay. Or I can write this as W1 sigma 1 plus 1 minus W1 sigma 2. W1 here times sigma 1 in this case is 6%, so I get 0.06 here, plus 1 minus W1 times sigma 2 here is 10%, so 0.1. So I get what? 0.1 plus 0.06 minus 0.1, so minus 0.04 W. So the level of portfolio risk as a function of W1 is given by 0.10 minus 0.04 W. So far, so good. The expected return on this portfolio would be again W1 times the expected return on R1 plus 1 minus W1 times the expected return on R2. Expected return on the first asset is 4%, we said, plus 1 minus W1 times the expected return on the second asset is 8%. So this is 0.08 plus 0.04 minus 0.08, so it's minus 0.04 W1. Okay. So in a certain sense, what I have here is two assets.
Can you scroll up a little bit?
Yeah. So what I have here is the trade-off between the expected return on the portfolio on the y-axis against the level of risk, right? This is the return, expected return, I should say. This is risk. So asset 1 is here. So let me call it asset A and B, I guess that's better. I think asset A and asset B. So asset A is here. So it has an expected return of 4% and an expected return of 6%. This is where I have asset A. Asset B, use a different color. Asset B is here. With an expected return of 8% and a risk of 10%, a standard deviation of 10%. Okay. If I put together a portfolio consisting of asset A and asset B, I need to know how to join these 2 points together. Make sense? Because any combination of asset A and asset B will be somewhere in between these 2 points. So I need to know what the slope is between asset A and asset B. Okay. So to know the slope, if I have to know the slope there, what do I need? I need dy over dx. Dy here is the expected return on the portfolio over d on the risk. Make sense? So if I need to know the slope which joins up these 2 points A and B, where A is asset 1 and B is the second asset, for me to know how to join up these 2 points, I need to know what kind of slope there is between these 2 points, given that this is the relationship. This is the same as taking the expected derivative of the numerator with respect to W1 and of the denominator with respect to W1, because both of them are functions of W1. Okay. So the expected return, the slope between these two is the derivative of the expected return with respect to W1. So if I take the derivative of this with respect to W1, I get what? Negative 0.04. Right? If I take the derivative of this equation with respect to W1, I get negative 0.04. If I take the derivative of this with respect to W1, I get the slope is 1. So what does it mean? I get a 45-degree line because the slope is constant. It's not a function of W1 or sigma p. It's a constant, which tells me that I get a straight line which joins up these 2 points, whose slope of this line is equal to 1. All right, so let me stop there for a second and see if there's any questions here. Make sense? As to how I realize, first of all, that it's going to be a straight line. Second, to figure out what should be the slope of that line. It's a 45-degree line because slope is 1. And that's how I can join those 2 points up together.
They don't really understand where the W1, how the W1 came in.
From here to here, you mean?
Yeah.
Right. So this part is clear, right?
Yeah.
Okay. So then when we look at how do I relate expected return on the portfolio and sigma p and the risk on the portfolio, right? The common variable which relates both of them, they're just functions of W1, right? So if I have to get to this derivative, I can take the derivative of each of these functions with respect to the variable which is determining them, this and this are the same thing, right? In calculus terms, this is how much the expected return is changing when I change W1. This is how much sigma p is changing when I'm changing W1. So if W1 is changing the both in the same way in both of these dimensions, then this is the same as this.
I see it.
Right? It just makes my life simpler to just take derivatives of each of these functions with respect to W1 separately and then divide one over the other.
Sorry, Professor, quick question.
Yes.
The slope tells us the sweet spot, I guess, between what we want in terms of risk and expected value.
The slope tells us how to join these 2 points up for now, right? So if I choose some weight here, right? So if I want to get to this point on this line, I would choose W1 is equal to something. Let's say it's almost tilted towards W, it's almost closer to A. So let's say I choose this is 2/3 and W2 is 1/3. This is the combination of these two assets which will generate this portfolio here. Right? So that line here between A and B, the line segment between A and B is linear combinations of both asset A and asset B with different weights. So I can be anywhere. So if I said W1 equal to 1, I'll be at A. If I said W1 equal to 0, I'll be at B. If I said W1 as something between 0 and 1, I'll be somewhere on that line segment between A and B.
Okay. Oh, right. we're weighing how much of each we want to take.
Mm-hmm.
Got it.
Why would you not just invest all in investment B if investing in A and B together would lower your expected value of your portfolio?
No, I mean, we haven't said what is the optimal thing to do here yet. This is just all the possibilities that you can do. Given that these are the two assets, these are the possible combinations that you can come up with. Technically, this segment is only when there is no short selling. Right? I can form any portfolio between A and B when there's no short selling, which is to say both the weights can't be negative. Right? Then I'll have to be somewhere between A and B. I can be at A or I can be at B or somewhere in between A and B. But if I allow for short selling, then the segment extends. Right? So the rest of this segment extension beyond A and beyond B, this is going to come through when I allow for short selling. This is a segment where I allow for short selling. And the segment between A and B is only when I have no short selling allowed, where there's only positive weights. So if I want to get beyond B, which is the maximized return, this is basically you can see that I can get to this point here. The way I would get to this point here, this high expected return and this high level of risk, what would I do? I would short asset A and go long on asset B and get here. Right? I could form a portfolio here if I wanted.
That's always your goal, just to increase expected return, or not necessarily, because obviously the higher you increase expected return, the higher the risk will be also.
Yeah.
Chart.
So suppose your compensation is only tied to how much expected return you can earn, not on how much risk you're taking to earn that expected return. You're playing with other people's money. That's not your money. You're borrowing money. You're investing other people's money, and your compensation is determined by how high expected returns are for your portfolio, let's say. Given that if these are only two assets available, the optimal strategy in that sense would be to short asset A as much as possible and take all of those proceeds and go long on asset B and try to ramp up expected return as much as possible. So how much time do we have? Oh boy. Okay. The last thing I guess for today is that if I allow for short selling, if short selling is allowed, we've seen one aspect of it. One aspect of it was that we couldn't raise expected returns as much as we wanted. But if I can get below A as well, right? I can also sacrifice expected return if I want to lower the level of risk I carry, right? I can be on this part of the segment as well if I wanted to be. I could be here if I cared about expected return more than I cared about risk. I could be here if I cared about risk more than I cared about expected return, right? So in a certain sense, if short selling is allowed, any portfolio risk is possible. Right? For instance, suppose I want my level of portfolio risk to be 2%. Okay. I don't like volatility. I don't like risk. If I invest in asset one, I have to, my level of standard deviation is 6%. My level of risk is 6%. If I invest in B, my level of risk is 10%. I don't like either of those cases. I want lower risk than either of those two assets provides for me. So suppose I want only to take on 2% risk, 2% standard deviation and the thing. Okay, so what does it mean? So I know that sigma P in this case is given by this equation here, 0.1 minus 0.04 W1. So I set this equal to 2%. Is 0.10 minus 0.04 W1, which gives me a portfolio weight of 2 on W1 and a portfolio weight of -1 against the other. Right? It says go long on the asset with the lower volatility and go short on the asset with the higher volatility, with the higher risk. Okay? Make sense? But the problem here is, of course, if I follow this weighting scheme, if W1 star is equal to 2 and W2 star is -1, then on a portfolio of this weighting scheme, then the expected return on this portfolio is given by this formula here, 0.08 minus 0.04 W1. You can see where I'm going with this. This is 0.08 minus 0.04 times 2. I can lower risk, but it comes out as a massive sacrifice of expected return. I'll not make any money in this scenario. My expected return on the portfolio is 0%, but my level of risk is lower. So in a certain sense, this demonstrates that there's always a trade-off between risk and return. If I care about maximizing expected return, I short the asset with the lower expected return and go long on the asset with the higher expected return. If I care about risk more than I care about return, I short the asset with the higher volatility and go long on the asset with the lower volatility, lower risk. And I can use those combinations of just two assets to generate any kind of position I want. If I'm very, very risk averse, I can use the same assets to generate a lower level of risk, but also sacrifice the expected return with it. If I'm very, very risk loving, I love to gamble, I can dial up the level of risk and also dial up the expected return if I want. Okay. All right. Okay. Oh boy. All right. This is. I feel like I'm rushing a little bit. I mean, it's more to do with the fact that there's only 2 classes left, and I want to get through to the nice bits of CAPM. But if there's any questions, if I'm going too fast, let me know, obviously, so I can slow down. And then, you know, the point is that you understand what I'm talking about rather than me talking and then you don't get any of it. So we'll stop there for today, but I'm happy to take any questions on any of the materials so far.
Nice.
Thank you.
Thank you, Professor.
Thank you, Professor.
Yep.
Thank you, Professor. Thank you.
Right. See you on Thursday.